All right, good morning, and thank you for joining us. My name is Brian Sowers, and on behalf of Davie Kaplan, I'd like to welcome you to today's symposium on 2020 year-end tax planning. The agenda this morning includes a brief introduction, 20 minutes discussing key business tax provisions of the CARES Act, 20 minutes describing tax planning opportunities given the current political landscape, and 15 minutes for questions and answers at the end. The intent of this symposium is to highlight key planning items we feel are relevant to our client base. These highlights are to serve as a call to action for our clients to reach out to their Davie Kaplan contacts or one of today's presenters to discuss details pertaining to their specific circumstances. Now for some administrative items. All attendees are muted for the entire session, including the Q&A portion. The webinar's control panel has multiple sections. The handouts section enables you to download today's slides. The questions section allows attendees to write in questions to the presenters. We encourage questions to be submitted all throughout the session. We will attempt to respond to them at the end. We plan to follow up with the submitters of questions that we are unable to address. As a means to introduce today's speakers, I have a confession to admit. I am an Olympics junkie. No matter if it's the Summer or Winter Olympics, whenever they are on, I envelop myself in them. Some of you may recall 28 years ago, leading up to the 1992 Summer Olympics in Barcelona, that Reebok aired a multi-million-dollar advertising campaign touting two American decathletes, Dan and Dave. They were expected to compete for the gold medal. Things went awry when Dan no-heighted in the pole vault in the Olympic qualifiers and failed to make the US team. Dave went on to win bronze in the Olympics. Unlike Dan and Dave from 1992, I expect our own Dan and Dave to provide gold medal worthy presentations today. And now I'd like to turn it over to Daniel Nitschke.
Okay, thank you, Brian, for that very informative introduction. And thank you all for joining us today. My name is Daniel Nitschke. My portion of the presentation today will cover business highlights of the 2020 CARES Act. After my piece is done, my associate David Edmondson will be discussing post-election 2020 tax planning opportunities and considerations. So my presentation is going to focus on some of the major business tax relief items provided by the CARES Act. The topics that we are going to cover are listed on the slide. These topics include net operating losses, or NOLs, qualified improvement property, or QIP, business interest expense limitation, excess business loss adjustment, or ELA, the payroll tax deferral, the payroll protection program, or the PPP, and employee retention credits. I will start off with a very brief overview of the CARES Act. Now, the CARES Act is an acronym for the Coronavirus Aid, Relief, and Economic Security Act that was signed into law on March 27, 2020. The $2.2 trillion bill was passed by Congress with overwhelming bipartisan support in order to help protect the American people from the public health and economic impacts of COVID-19. The act is significant because it is the most expensive piece of legislation ever passed by the US government. The CARES Act has provided fast and direct economic assistance for American workers, families, and small businesses, and has preserved many American jobs. Now, the majority of the tax relief included in the CARES Act is designed to increase liquidity in the economy, largely through the relaxation of limitations on business deductions and the deferral of taxes, and also with the recovery rebates for individuals. It is important to note that the CARES Act is a federal program and that New York State has decoupled from all of the tax reforms included in the CARES Act. Now, this can be potentially have a major impact on tax planning for New York residents. Now, our first topic is net operating losses. But before we dive into our topics related to the CARES Act, it is important to have a basic understanding of some of the other recent changes to the tax law that originated with the Tax Cuts and Jobs Act. Now, the CARES Act impacted some of the changes to the tax law that were included in the Tax Cuts and Jobs Act, and I will refer to this act as the TCJA going forward. The TCJA was signed into law on December 22nd, 2017, and was the most sweeping tax law reform legislation since 1986. Most of the changes went into effect beginning with the 2018 tax year. Now, the slides for this presentation have been set up to explain the tax law before and after the TCJA, and then the impact from the CARES Act, some of which is retroactive. The TCJA eliminated the carryback of net operating losses, or NOLs, for tax years after 2017 and allowed for the indefinite carry forward of NOLs. Prior to the TCJA, an NOL generally could only be carried back 2 years. Now, NOLs arising in tax years beginning after 2017 could only reduce 80% of taxpayers' taxable income in the tax year used. Any unused NOL could be carried forward indefinitely. Now, the CARES Act reinstated the ability to carry back NOLs for tax years 2018, 19, and 20, and increased the carryback period from the general period of 2 years and increased it to 5 years. As a result, taxpayers have the ability to amend previously filed 2018 and 2019 tax returns to carry back losses as far as 2013 and receive refunds of previously paid taxes. In addition, the 80% of taxable income limitation for NOLs has been eliminated, therefore increasing the potential tax benefit from an NOL. So what this means is if your business was impacted by the recent economic slowdown and has incurred losses, this change may offer an opportunity to get you much needed cash flow for your business. Okay, so next we're going to talk about qualified improvement property. So what is qualified improvement property, or QIP? Well, here's the definition. QIP is any improvement made by the taxpayer to an interior portion of a building that is non-residential real property, as long as that improvement is placed in service after the building was first placed in service by any taxpayer. QIP specifically excludes expenditures for the enlargement of a building, elevators or escalators, and the internal structural framework of a building. Now, why do we care about QIP? Well, the Tax Cuts and Jobs Act created the QIP category of property and intended to give this type of property a 15-year depreciable life, therefore making it eligible for bonus depreciation. However, Congress failed to update the law properly, and as a result, QIP was depreciated as 39-year property and did not qualify for bonus depreciation. Now, in order to qualify for bonus depreciation, an asset must have a depreciable life of 20 years or less. A technical correction was promised by Congress. However, this never made it into the final version of any piece of significant legislation. Now, that is until the CARES Act. Now, the CARES Act corrected the congressional oversight by defining QIP as 15-year property eligible for bonus depreciation. This technical correction allows any expenses incurred by owners to make improvements to the physical premises related to these businesses to be accelerated into the 2017 or 2018 tax year on an amended return, or the 2019 tax year on a return that this year was due July 15th, 2020. At this point, since we're past the due date, a previously filed 2019 return could be amended. Now, technically, any QIP that uses a 39-year life is now incorrect and must be changed to a 15-year life going forward. So what does this all mean for you and your businesses? This law correction may allow your business to accelerate depreciation in order to minimize taxes and potentially to generate net operating losses that now can be carried back up to 5 years in order to get refunds of taxes paid in previous years. Okay, our next topic is the business interest expense limitation. Now, the TCJA limited the amount of allowable deductions for business interest for tax years beginning after 2017. The limitation was 30% of the taxpayer's adjusted taxable income for the year. Now, generally, this limitation does not apply to taxpayers with average annual gross receipts for the prior 3 years below an inflation-adjusted amount of $25 million. Now, the CARES Act increased the limitation of business interest expense from 30% to 50% for the 2019 and 2020 tax years. So there could be a small benefit from this change. Okay, our next topic is excess business loss limitation. Now, the TCJA restricted the use of business losses of non-corporate taxpayers, so non-C corporations, individuals, or any pass-through entities that pass through income to individuals. Beginning in 2018 through the 2025 tax year, taxpayers could only deduct up to $250,000 or $500,000 if married filing jointly of these business losses against non-business income. This loss limitation is adjusted for inflation each year. Now, amounts above the threshold are considered excess business losses and carried forward and treated as part of the taxpayer's net operating loss carry forward in subsequent taxable years. Now, the CARES Act retroactively eliminated the excess business loss limitation rules for 2018 and 2019 and suspended the rules for 2020. Taxpayers have the ability to amend 2018 and 2019 returns to get a refund if impacted by this excess loss adjustment on previously filed returns. The excess business loss rules will be reinstated for tax years after 2020. So basically, this is just another way for taxpayers to minimize taxes and potentially have access to cash refunds from previously paid taxes. All right, our next topic is the payroll tax deferral. Now, in order to free up employers' cash flow and retain employees during times of quarantine or shutdown, the CARES Act allows for the deferral of the payment of the 6.2% employer FICA portion of payroll taxes incurred from the end of March through December 31st, 2020. Now, the deferral of payment is completely up to the employer. This is optional. Now, if the option is chosen, 50% of the deferred payroll taxes are due on December 31st, 2021, and the remaining 50% on December 31st, 2022. Now, this is a way for your business to get an interest-free loan from the government and to help with cash flow. All right, most of you have probably heard about this topic, the Payroll Protection Program, otherwise known as the PPP. Now, the Small Business Administration was provided with $659 billion to provide paycheck protection loans that may qualify for forgiveness to businesses impacted by the coronavirus. The PPP established loans designed to provide a direct incentive for small businesses to keep their workers on the payroll. The loan application period was from early April through early August 2020 and is now over. So why are we talking about this? Because many of you, your businesses probably have already received paycheck protection loans, and you have some questions about how it all works and the potential forgiveness. So this slide has a lot of information, and it covers the criteria for PPP loan forgiveness. Now, the Small Business Administration will forgive loans if all of the employee retention criteria is met and the funds were used for eligible expenses. So I'll just go over some of the main criteria for loan forgiveness, and everything is not included on this slide, but some of the major bullet points are included on this slide. So some of the main criteria for forgiveness are the loan proceeds are used to cover payroll costs, most mortgage interest, rent and utility cost over the 24-week period after the loan is made, or potentially an 8-week period if elected by the recipient. Employee compensation levels must be maintained, and no more than 40% of the funds may be spent on non-payroll costs. Now, any portion of the PPP loans that are not forgiven will have a maturity of up to 5 years at an interest rate of 1%. For loans of $50,000 or less, there's a new one-page forgiveness form that allows automatic exemptions from any potential full-time equivalent employee or for wage forgiveness reductions. Now, for those companies that have received loans, the loan forgiveness portion is not taxable. However, currently the IRS has taken the position that the expenses paid by the PPP proceeds, and eventually if they are forgiven, are not deductible. So this effectively makes the forgiven portion of the loan taxable. Now, this was not the intention of Congress to disallow the deductibility of the expenses paid using the loan proceeds. However, this was not explicitly stated in the law, and we are currently awaiting future legislation on this to determine whether or not the forgiven loan proceeds are effectively taxable or non-taxable. Now, Davie Kaplan remains cautiously optimistic that this will be cleared up in a taxpayer-friendly way in the future. However, at this point, we have no clear facts on how this is going to proceed. Now, if your company has received a PPP loan, Davie Kaplan can help you with your loan forgiveness applications. Okay, and my last topic today is the employee retention credit. Now, like the PPP loans, the employee retention credit was also designed to provide an incentive for small businesses to keep their workers on the payroll. It's very important to note that businesses who received a PPP loan are ineligible for this credit. However, businesses that did not receive a PPP loan may receive a refundable credit against employment taxes equal to 50% of the qualified wages paid to employees during the COVID-19 crisis from mid-March through December 31st, 2020. The maximum credit per eligible employee is $5,000. So for companies who did not receive a PPP loan and do have a number of employees on the payroll and have had them throughout this crisis, throughout 2020, this can be a pretty lucrative credit. Now, employers can get immediate access to the credit by reducing employment tax deposits that they are otherwise required to make. If payroll tax forms have already been filed without claiming the credit, the IRS has authorized the credit to be claimed on an amended payroll tax return. So Davie Kaplan can help you determine if your business qualifies for this credit and can prepare amended payroll tax returns if necessary. Okay, thank you all for listening. At this point, I'm going to switch over to David Edmondson. And there we go. So thank you, David, and we look forward to hearing from you.
All right. Thank you, Dan. As we'll see, the provisions in the CARES Act will have a significant impact on tax planning for 2020. Another area that many clients are concerned about is the tax planning landscape after the recent presidential election. As we'll see, we'll go through the proposals put forth by the Biden administration and see what the Republican alternative would have been, and figure out what the best opportunities to do in 2020 as a result. The areas that we would like to talk about in the next 20 minutes are income tax proposals for individual taxes, estate taxes, and business taxes. So the current political landscape is that Joe Biden has received sufficient electoral votes to be considered president-elect of the United States, and it looks like the Democratic Party will retain control of the House of Representatives. The Senate, however, is the wild card. We're awaiting the outcome of 2 runoff elections in Georgia that will decide control of the Senate. If the Democratic Party wins both elections, then we'll essentially have a tie in the Senate that can be broken by the vice president. Now, we have a couple of issues with the current situation. The first is that we don't even know who's going to control the Senate in the following year, so that makes tax planning in 2020 especially difficult. Even if the Democratic Party does succeed in both elections, they'll only have the narrowest of margins, which means that any tax proposals will need support of both progressives and moderates within the Democratic Party, which really limits the aggressiveness of proposals that President-elect Biden can put through next year. So given this information, we're not expecting radical change in the tax law. However, given the federal deficits from the Tax Cuts and Jobs Act and the considerable pandemic relief that Dan just talked about, revenue raisers may be unavoidable. Now, in the area of individual taxes, we see that both President-elect Biden and Trump and the Republican Party have put forth provisions, especially to help the middle class. So President Trump and the Republican Party in the election were favoring tax cuts for the middle class, and they were also favoring making permanent several expiring provisions of the Tax Cuts and Jobs Act. Now, as we'll see throughout the presentation, there are many proposals or provisions in the Tax Cuts and Jobs Act that are expiring at the end of 2025. So what this means is, even if Congress is deadlocked and doesn't pass any legislation in the next 4 years, we will see tax increases in 2026 as these provisions expire. Now, if we turn to President-elect Biden's plan, he has what he calls the Build Back Better plan that includes several incentives and tax credits in the areas of manufacturing, caregiving, income equality, and infrastructure and clean energy. So with all these tax credits comes the need to pay for the tax credits. So we are also looking at the possibility of tax increases in several areas. In the individual tax realm, for ordinary income, we're seeing potential increases in ordinary income. What President-elect Biden would like to do is return the top marginal tax rate for individuals from the current rate under the Tax Cuts and Jobs Act of 37% up to the previous maximum of 39.6%, which is contrasted with the Republican plans that would favor tax cuts for the middle class. Capital gains are another area where we could see significant change. Again, Biden's primary plan here is not to tax middle class taxpayers, so these tax increases are primarily targeted at higher income taxpayers. In the case of capital gains, what Biden would like to do for taxpayers earning more than $1 million per year would be to tax capital gains at ordinary tax rates. So if we do have a 39.6% marginal tax rate, and if we include the 3.8% net investment income tax on investment income, we could see a tax rate for capital gains of up to 43.4%. So this is essentially a doubling of the capital gains rate if all of this goes into place. The Republican proposal was to cut capital gains rates, and they also favored adjusting the cost basis of assets for inflation so that the gain recognized on the sale of assets would only reflect the intrinsic increase or appreciation on the assets and not the inflation just caused by the economy. The area of itemized deductions is another place where we may see more limitations placed on high-income taxpayers. Prior to the Tax Cuts and Jobs Act, there was a limitation on itemized deductions whose incomes over a threshold, and then it began to phase out $3 for each dollar of income over the threshold. What President-elect Biden would like to do is reinstitute this threshold for taxpayers with income over $400,000. Now, this is a provision that would expire anyway under the Tax Cuts and Jobs Act, so in 4 years we may see this limitation kick in either way, though not necessarily the $400,000. Secondly, Biden would like to limit the benefit of itemized deductions to 28% of taxable income. So that itemized deductions could only offset 28% of taxable income for taxpayers over that $400,000 threshold. Another area that isn't part of Biden's plan, but is popular with many other Democrats in Congress, is the state and local income tax limitation. So under the Tax Cuts and Jobs Act, deductions for state taxes and real estate taxes are capped at $10,000. What many Democrats would like to do is eliminate that tax. Obviously, this is especially popular in high tax states like New York. Payroll taxes is another area we could see increasing taxes on taxpayers with income over $400,000. So what President-elect Biden would like to do is remove the current Social Security tax cap on wages. So currently, wages are only subject to Social Security taxes. That's the 6.2% tax that both employees and employers pay. This tax currently stops at about $137,000 of wages for both the employee and the employer. And what Biden would like to do is have it kick in again at $400,000 of wages. So this would create a donut effect, essentially, where you would pay Social Security tax up to the $137,000 or so threshold. Social Security tax would go away up until $400,000 and then kick in again. So as we can see, this is another significant tax increase that could affect high income taxpayers. All of these tax increases would then pay for a variety of tax credits and incentives that President-elect Biden is proposing. So we could see increases in the child tax credit, credits for contributions to retirement accounts, credits for purchases of a new principal residence, credits to offset rent and utility bills for low-income taxpayers, student loan forgiveness, and the like. So given this potential for tax increases in 2021, the question is, what should individual taxpayers do now? So this is an area where normally we would recommend trying to defer income near year end to next year so that you don't have to pay tax on it in April, but could defer that a year. This is a year where taxpayers may want to consider actually accelerating their income, especially with the possible increase in capital gains rates. Taxpayers with appreciated assets that are considering selling them in 2021 may want to consider making those sales in 2020 to take advantage of the current preferential capital gains rates. Also, taxpayers owning corporations or S corporations with earnings and profits may want to consider taking dividends in 2020 instead of 2021. Now, when we look at deductions, again, because tax rates may go up in 2021, you'll get a better bang for your buck taking those deductions next year rather than this year so that they can offset income that's taxed at higher tax rates. So taxpayers may want to defer deductions until next year rather than accelerating deductions until 2020. Now, real estate taxes and state estimated taxes depend on what happens with that SALT cap that I talked about. If the SALT cap is eliminated, then real estate taxes and estimated tax payments made in January might be fully deductible, depending on how things go with the fees limitation. Or whereas if they were paid early in 2020 and we received relief on the SALT cap, then maybe we don't get to deduct those over $10,000 when we might have been able to if we waited. So we're recommending, if you've already reached the $10,000 limit for state and local taxes, don't prepay those taxes in 2020, wait until January to pay those taxes. Estate and gift taxes are an area where we could see significant change. Currently, there's an exemption for estates of $11.5 million, which allows that dollar value of estates not to be subject to estate tax. So that once the estate reaches that threshold, and that's a per taxpayer threshold, then they would be subject to a 40% tax rate. Under President Biden's proposals, he has said that he would like to restore the estate tax to what he calls historic norms. So this might mean a reduction down to the 2009 estate tax levels, which was a 3.5% or $3.5 million exemption, and a top marginal tax rate for estates of 45%. So this would be a significant increase in the dollar value of high dollar value estates that could be subject to estate tax. Additionally, this is an area that again will change after 2025 when the provisions of the Tax Cuts and Jobs Act expire. So under the Tax Cuts and Jobs Act, the threshold was raised from $5 million to the current threshold. So we could see inflation adjusted $5 million rate in 2026 if no new legislation is passed. Additionally, under President-elect Biden's plan, he would like to eliminate the step up in basis, which is another huge change. So currently, assets that are inherited are stepped up, as we call it, to fair value at the date of death. so that if assets were purchased years ago and have appreciated significantly in subsequent years, the beneficiaries of the state can sell those assets and only recognize capital gain on the appreciation since the date of death. If this step up were eliminated, we could see significant capital gains when beneficiaries sell inherited assets. We may also see other limitations on estate planning strategies, such as elimination of the ability to discount family limited partnerships. One piece of good news is that the IRS has already stated that taxpayers who utilize the $11.58 million exemption in 2020, if that exemption is later reduced in future taxable years to, say, the $5 million or $3.5 million levels, the IRS will not claw back the previously claimed exemption, which means that there's an opportunity in 2020 to utilize this full exemption before it is decreased. So taxpayers may want to consider gifting in 2020 before year end to utilize the increased exemption. There are several options available to utilize this exemption. One popular method right now is spousal lifetime access trusts, or SLATs, which allow married couples to gift assets to estates for each other's benefit and lock in that exemption while still retaining control of the assets in the marital group. Some other possibilities are family limited partnerships, potentially defective grantor trusts, and Q-tip trusts. Because some of these provisions, strategies take a while to implement, we recommend that taxpayers should get started on this immediately rather than waiting until the year end to try to lock in these exemptions. Corporate tax rates are another area where we may see increases in the coming year. Under the Tax Cuts and Jobs Act, the maximum corporate tax rate was reduced to a flat 21%. And what Biden would like to do is increase that to 28%. President-elect Biden has also proposed a minimum tax of 15% on corporations with book income over $100 million. So book income is essentially your financial statement income. So this would essentially be a return of a type of tax like the previous corporate alternative minimum tax. And another area that we may see changes is the qualified business income deduction. Now, this is a very popular deduction instituted under the Tax Cuts and Jobs Act that allows a 20% deduction on business income for self-employed taxpayers, partners and members in LLCs and partnerships, and shareholders in S corporations, provided that certain thresholds and requirements were met. So what Biden would like to do is phase out this deduction for taxpayers with income over that $400,000 threshold. Now, this is an area that is again slated to expire in 2025. So in the future, we may see a decrease of this exemption either way. But if Biden's plan goes through, it could happen earlier. And finally, bonus depreciation. This is an area that isn't specifically targeted in Biden's plans, but it is another area that is terminating in 2025. So unlike several of the other provisions, however, bonus depreciation will actually start to phase out earlier than 2025. So beginning in tax year 2023, but bonus depreciation will begin phasing out. And each year thereafter will decrease until finally in 2026, it will be completely eliminated. So the question here is, will bonus depreciation be revived as it has several times in the past, or will this be the time that bonus depreciation finally fades away? So we'll have to break out our crystal ball to find out, but it may happen. Carried interest is another area where we may see changes. This is a method of compensating partners in certain investment funds, and it's another area that President-elect Biden would like to limit. Now, again, all these tax increases would pay for certain tax incentives, and this is an area where we do see some across the aisle potential for cooperation, because both the Biden administration and the Republican plans favor tax incentives for manufacturers, especially in the realm of bringing jobs back to the United States, production in the United States, and the like. So we may see some sort of tax credits or incentives in this area. Time will tell. And finally, Brian would like to see new incentives and restored incentives for energy efficiency, vehicle tax credits, etc. So this is another area that we may see changes if we can put in place some of those tax increases that Brian would like to propose. So again, given the possibility for increased tax rates for businesses and limitation of the qualified business income deduction in 2020, taxpayers may want to consider whether they want to accelerate taxable income into 2020 to take advantage of the 21% corporate tax rate and the qualified business deduction if taxpayers think that those tax rates may go up. Timing of deductions. Now this depends on a few different factors. So businesses that are expecting taxable income in 2020 and 2021 may want to defer those deductions into 2021, again, to offset the higher tax rates that could go into effect next year. So businesses that are considering buying equipment, for example, you want to consider, should I place that equipment in 2020 and take the deduction this year, or 2021 and defer that deduction until next year? Now, a catch here is the net operating loss provisions under the CARES Act that Dan talked about. So in this area, if we generate a net operating loss in 2020, we have the ability to carry back that loss to prior tax years that we had taxable income and pay taxes. And that would allow us to generate an immediate tax refund and get cash flow right away for that loss that was generated in 2020. If we defer that loss to 2021, now we can only carry that loss forward. So taxpayers that are expecting net operating losses in this year, and due to the current economic provisions, many taxpayers are experiencing losses. Those taxpayers may want to increase the losses in 2020 so that they can be carried back, as opposed to deferring those losses in 2021. So all of these areas are tax planning opportunities for our clients, both individual tax planning, gift and estate tax planning, and business tax planning. So we encourage our clients to reach out to us on what all of these changes may mean to your particular tax plan. Thank you.
Thank you, Dan and Dave. Gold medals to you both. So that brings us to the Q&A portion of this symposium. We do have a couple of questions submitted, but still, if people would like, they can submit them, whether it's a question or even a comment. We can pass that on. One question here I'd like to take, I'm going to read it. Given the uncertainty around deductibility of forgiven PPP expenses, should we wait to after 2020 to submit for forgiveness and take the expenses in 2020? I'm going to have two parts. First, about the timing of application, I'll turn it over to Dan.
Yes, so you have 10 months after the 24-week period ends after receiving the loan proceeds in order to submit your application for forgiveness. So, for example, if you receive the loan in June, after the when you account for the 24 weeks and then an additional 10 months, you would have until potentially up to around November of 2021 to submit the forgiveness application.
But the second part of that, I'll turn over to Dave for revenue guidance that came out, I believe either last night or this morning.
Thank you, Brian. So yeah, we have received late breaking news, if you will, on deductibility of the expenses paid for with the payroll protection loans. And it's not taxpayer friendly. What the IRS is proposing in Revenue Ruling 2020-27 is that expenses paid for by the payroll protection loan, where the taxpayer reasonably expects to receive forgiveness of that loan, are not deductible in the current year. And this is regardless of whether the taxpayer has already applied for the loan or is merely expecting to apply for the loan and has already met the requirements for forgiveness. Now, this is an area where we at Davie Kaplan and many other experts feel that the IRS is overreaching and essentially going against the desire of Congress in passing the CARES Act. So this is an area where we hope that we will see further clarification from Congress allowing full deductibility of these expenses. But it is an area that clients should reach out to us on what we should do for the tax planning estimates in January or December of this year. Thank you.
Thank you, Dave. Another question we'll address, I think, is again for you, Dave. Just looking for a clarification on the no clawback for the $11.5 million exemption.
Right. Yeah. So the IRS has put out notification that it does not expect to reclaim that exemption. So essentially, if taxpayers gift and use up the $11.5 million exemption in 2020, the IRS has stated that it does not intend to attempt to reduce that exemption if it's reduced in future years. So this is really an opportunity to take advantage of that exemption this year. And given the current climate and the provisions that are going to expire under the Tax Cuts and Jobs Act, we think it's a good idea to try to utilize that exemption now for high value states rather than waiting to see what happens in 2021 and future years.
Thank you again, Dave. Not a question, but a comment. Dave did speak to QBI, that 20% deduction available for pass-through entities. More of a call to action, as Dave mentioned, to reach out to us. There are some planning opportunities around QBI while it still is in place. There's items such as distributions versus bonuses to owners, aggregating businesses to maximize the QBI deduction. If there's ability to shift expenses between companies to avoid or mitigate the thresholds and limitations that are applied, there's lots of opportunities for planning just to maximize that deduction and reduce your overall tax liability. Any other comments, Dave or Dan?
Yeah, I'd just like to say, a lot of you may not have submitted a question or may have a more specific question to your personal circumstances, and we would encourage you to reach out to us directly, to the partner or manager on your account for any specific questions for your businesses that you might have.
Definitely. All right. Well, I think with that, we're running a little ahead of time, but thank you all for attending, and feel free to reach out to us when and if the need arises. Have a great Thanksgiving. Thank you all.
Thank you.
Thank you.